You want to see the Fed start raising interest rates at a faster pace. How come?
I want to get them back to what they call normal. And it's interesting, if you talk to the Federal Reserve governors, John Williams from San Francisco is close to us. He made a comment that originally normal was 4%. They lowered it all the way down to 3%. That's a 25% cut. And to me, to say normal is a 3% interest rate, I've been in this business 30 years. I'm used to rates up in the 8s and 9s. I would like to, though, see them get back to at least a 3% rate, because I think the fact that the markets, there's no value to saving, there's no value to fixed income. Think about this entire generation. I've got 3 daughters that are now, 2 of them are married, they're starting to save, and they look at their money market fund and they go, well, that's just a parking place because it earns basically 0. We need to get that generation, the millennials, back saving money.
Right? They're rolling off the balance sheet. That's going to put upward pressure on long-term yields.
I hope it does, because I want a positively sloped curve. I don't want a flat curve.
But that's contractive, right? It makes it that much harder for them to raise on the front end.
I think the long end of the curve, though, will react to the short. It's going to still be a fairly flat curve, but I think we're still going to have a slightly positive slope. There's, like I said, there's too much long-term money, and a lot of that has very long liabilities, like us, so a 30-year horizon. So it wants duration. I interviewed Larry Fink this morning on a panel, and that's what he brought up was, man, everybody in the world wants duration. That's what's going to cause the yield curve to stay flat, because when you're buying duration, you're not going to go to the UK or Japan and buy a 10-year. You're going to come here and buy a 30-year.